Hi everyone, welcome to day 62 of our 365 day life challenge. Today we are diving into the world of asset classes. Whether you are watching it live or catching the recording later, understanding asset classes is essential for any investor. So let's get started. So basically, what are asset classes? Asset classes are groups of investments that have similar characteristics and behave similarly into the market. They can include stocks. Stocks means shares, bonds, real estate, and commodities, and many more things. Essentially, they are the building blocks of your investment portfolio. For beginners, understanding asset classes is very important. Imagine that you're building a house. Each asset class is like a different material you can use, like wood for the frame, bricks for the walls, and so on. So each material serves a different purpose and has its own strengths and weaknesses. Similarly, each asset class has its own risk and return profile. So there are several main types of asset classes. So let's look at them one by one. First one is the stock. Stock represents ownership in the company. You become the owner. So as a owner, you get the profit and you get the share of the ownership. So example, say shares of the companies like Tata Motors or Infosys. Second asset class is bonds. Bonds are the debt securities which are issued by government or the corporations. Example can be RBI tax-free bonds. Third example or the third asset class is the real estate. Real estate is commercial property or a residential property or investments into the land, or it can be the investment into REITs. Fourth asset class is commodities. Physical goods like gold, oil, or agricultural products comes under the commodities. Fifth asset class is cash equivalent. Highly liquid instruments like money market funds. I hope you're clear on the basic concepts of asset classes so far. So the best asset class for you depends upon your financial goals, risk tolerance, and time horizon. So the stocks generally offer higher returns, but they come with more risk, while bonds provide stability, but they have lower returns. Diversification across multiple asset classes is often recommended to manage the risk. In addition to traditional asset classes, there are also alternative asset classes like hedge fund, private equity, and cryptocurrencies. These can offer unique opportunities for diversification and potentially higher returns, but they often come with higher risk and less liquidity. So, your investing strategy should align with your chosen asset class. For example, suppose if you're investing into stocks for long term growth, you should focus on buying and holding high quality companies. If you're investing into bonds for income, you might you might choose safer and investment grade bonds. So, when classifying assets, consider factors like liquidity. Okay, what is liquidity? How easily an asset can be bought or sold is called liquidity. Second factor you should consider is the volatility. That is, how much the price fluctuates. Third factor is correlation. Now, a correlation is a mathematical term, but it's easy to understand. Basically, it indicates how closely an asset price moves with the other assets. Example: suppose how closely bonds and equity, like what is the relation between the two, is indicated by the correlation factor. These factors help determine the risk and the return characteristics of each asset class. So now let's discuss why is diversification important when you're investing. Diversification involves spreading your investments across different asset classes to reduce the risk. If one asset performs very poorly, the other may perform better, helping you to balance out your overall portfolio. It's like not putting all your eggs in one basket. Investment risk can be thought of as a ladder with the lower risk investments at the bottom and the higher risk investments at the top. So this ladder includes first one, the cash equivalent, which has the lowest risk but also the lowest potential returns. The second one is the bonds, generally less risky than the stocks but offer higher returns than the cash equivalent. Third one will be stocks, which gives you higher risk but potentially it comes with the higher returns. After that comes, real estate and commodities, moderate to high risk depending upon the market conditions. And on the top, it's alternative assets, highest risk but also potential for highest returns. Understanding asset classes is fundamental for building a successful investment portfolio. By diversifying across different asset classes and considering factors like risk and return, investors can create a well balanced portfolio suited to their financial goals and risk tolerance. Remember, investing is a journey, so take the time to educate yourself and make informed decisions along the way. Let's look at some rules for successful investment. First one, set clear financial goals. Second one, understand your risk profile. Third one, diversify your investments across asset classes. Fourth, invest for the long term goals. Fifth, keep emotions in check. Sixth, stay informed about market trends and economic indicators. Seven, regularly review and rebalance your portfolio. Eighth, consider seeking professional advice if needed. Thank you for joining us on day 62 of our challenge. Stay tuned for more insights and tips on navigating the world of finance and investing. We are coming up with a webinar. The link and the details for the same has been posted in the comment box. See you again tomorrow and see you for the webinar also. Bye bye.